Every month, a chunk of your money leaves your account and goes to HMRC before you have even seen it. You do not approve it on the day. You do not sign anything. It just goes. And the uncomfortable part is this: a surprising amount of that tax depends on codes, thresholds, forms, assumptions, and little rules most people never check. HMRC may publish the rules, but they are not going to sit you down and make sure you claimed everything. So these are 10 legal tax doors people walk past every year. Some are small, some can be worth thousands, and if even one applies to you, it could be money you have been leaving on the table. Number 10. The code that quietly robs you. Every payslip has a little string of numbers and letters on it, your tax code. Most people never look at it, but that code tells your employer how much tax to take. So if it is wrong, the mistake does not happen once. It happens every month. People end up on the wrong code after changing jobs, getting a bonus, losing a company benefit, starting a second job, or because HMRC is working from an old estimate. For many people, the standard code is 1257 litres. If yours looks completely different and nobody has explained why, it does not automatically mean it is wrong, but it does mean you should check. A wrong tax code is like a subscription you never signed up for, draining you quietly through your payslip. Open the HMRC app or your personal tax account. Check what HMRC thinks you earn, what benefits they think you have, and whether they are collecting tax for something that no longer applies. If you have overpaid, you may be able to claim money back from previous years. Number 9. The work-from-home refund people missed. During the work-from-home years, millions of people were heating their own rooms, using their own electricity, running their own broadband, and turning kitchen tables into offices. HMRC had a relief for that. If you were required to work from home, and your employer did not reimburse you, you could claim tax relief on a flat weekly amount without keeping receipts. This has changed. For the current tax year, employees cannot claim working from home relief in the same way, but the old door is not completely shut. You can still check whether you were eligible in previous years and never claimed it. So this is not claim it for today. This is check whether you missed it when you could claim. It is like realizing the little office you ran from home came with a refund nobody mentioned. Search working from home tax relief on gov.uk and check the previous year rules. Number 8. The interest. They tax through an estimate. For years, savings accounts paid nothing. Then rates came back, and suddenly people started earning real interest again. But not all savings interest is taxable. A basic rate taxpayer can usually earn up to £1,000 of savings interest a year, tax-free. Higher rate taxpayers usually get £500. Additional rate taxpayers get no personal savings allowance. Banks report interest to HMRC, and HMRC can adjust your tax code using that information. Sometimes that is right. Sometimes it is based on estimates, old figures, or interest you are no longer earning. So you might be paying tax through your payslip on savings interest that is within your allowance or lower than HMRC thinks. It is like a waiter adding a service charge because of what you ordered last time. Check your actual interest. Check your allowance. Then check whether your tax code includes savings income. If the estimate is wrong, update it. Number 7. The first 1,000 nobody understands. People panic the moment they make a bit of extra money. You do an odd freelance job. Walk a neighbor's dog. Sell a few things online. Help someone with a service and get paid. Suddenly you think, do I need to tell HMRC? Am I a business now? There is a trading allowance. If your gross trading or casual self-employed income is £1,000 or less in a tax year, you may not need to tell HMRC or pay tax on it. That is not the same as selling your old phone or trainers. Selling your own unwanted stuff usually is not a trade in the first place. This is about small trading or side hustle income. And if your trading income goes over £1,000, the allowance can still help. In many cases, you can choose to deduct the £1,000 allowance instead of actual expenses. It is a tax-free starter lane for small side income, not a loophole, just a rule most people only discover after stressing themselves out. Number 6. The driveway that pays your bills. You leave for work. Your driveway sits empty. Somewhere nearby, a commuter is paying a fortune for parking. That empty patch of tarmac might be an asset. There is a separate property allowance of up to £1,000 a year. It can cover small amounts of property income, including renting out a driveway, garage, storage space, or similar. And it is separate from the trading allowance. So in the right circumstances, someone could have £1,000 of trading income covered by the trading allowance and £1,000 of property income covered by the property allowance. That does not mean free money for everyone. You still have to meet the rules. And if your income is higher or your expenses are bigger, You need to check what works best. But most people never realize the allowance exists. It is like discovering your driveway had a part-time job this whole time. Number 5. The uniform refund. If you wear a uniform, buy tools, maintain specialist kit, or pay professional membership fees your job requires, you may be able to claim tax relief. Nurses, mechanics, healthcare workers, hospitality staff, tradespeople, cleaners, engineers, security staff, hairdressers. Loads of workers sit on this and never claim. If your employer does not reimburse you, HMRC may allow tax relief. In many jobs, there are flat rate expenses, so you do not need to prove every wash, repair, or replacement. HMRC has standard amounts for different trades. It may not be huge each year, but if you can backdate it, a small claim can become a useful refund. It is like a lost property office full of little bits of your money. Search flat rate expenses on gov.uk. Check your job, professional fees, subscriptions, tools, and uniform rules. Ordinary clothes do not count just because you wear them to work, but branded, protective, specialist, or required kit may. Number 4. The pension relief. They do not always send automatically. You pay into a pension. You hear tax relief and assume it is all handled. Sometimes it is, but if you are a higher rate taxpayer paying into certain personal pensions or relief at source schemes, there may be extra relief you need to claim yourself. Here is the simple version. You put £80 into a pension, and the provider turns it into £100 by claiming basic rate relief. But if you pay 40% tax, that may not be the full story. You may be entitled to extra relief, and depending on your scheme, you may need to claim it through self-assessment or by contacting HMRC. That extra part often sits behind a form, a tax return, or a phone call. It is like a cashback deal that only pays if you submit the claim. If you are a higher rate taxpayer, check whether your pension is relief at source, net pay, or salary sacrifice. If payroll already handles it, fine. If not, you may be missing money. For some people, this is worth thousands. Number 3. The 60 grand cliff edge. You are kids, you claim child benefit. Then one of you gets a pay rise, bonus, overtime, or a new role, and your income crosses £60,000. Suddenly, HMRC starts clawing back child benefit through the high income child benefit charge. From £60,000, the charge starts eating into it. By £80,000, it can be fully wiped out. But the number they judge you on is not simply your salary, it is adjusted net income. And pension contributions can bring that number down, so a family near the threshold may be able to increase pension contributions, reduce adjusted net income, keep more child benefit, and build retirement savings at the same time. That does not mean everyone should do it blindly. Cash flow matters, pension limits matter, but the principle is powerful. A pay rise can come with a hidden clawback. The trick is knowing which number HMRC is actually looking at. Number 2. The ambush on your first pension withdrawal. You finally reach the age where you can access your pension. You take a lump sum or flexible payment. You expect the money cleanly. Then HMRC hits it with emergency tax. The system can treat that first flexible withdrawal as if you will take the same amount every month for the rest of the tax year. So one large payment can be taxed like you suddenly earn a fortune. Thousands can be over-deducted. Not because you did anything wrong, but because the system guessed first and left you to claim later. It is like being charged for a full year of gym membership when you only came for one session. The reclaim route depends on the withdrawal. For many flexible withdrawals, where you have not emptied the pot, it may be P55. If you emptied the whole pot, it may be P53Z or P50Z. Do nothing and HMRC may eventually balance it out, but your money could sit with them for months. Check the deduction and use the right refund route. Number 1. The missing years that can cost you a fortune. Your state pension depends on your national insurance record. Most people assume theirs is fine. Often, it is not. Years raising children, time abroad, low-paid work, self-employment mistakes, gaps between jobs, years where credits should have been added but were not. Those gaps can reduce your state pension. For people whose NI records started after April 2016, you usually need 35 qualifying years for the full new state pension. If your record started before then, the calculation can be more complicated. So do not guess. Check. In some cases, you can fill missing years by paying voluntary national insurance contributions. A full Class 3 year is just under £1,000 in 2026-27. That sounds painful until you realise one extra qualifying year can increase your state pension every year for life, if it improves your forecast. Pay around £1,000 once, and it could return hundreds a year in retirement. But not every missing year is worth buying. Some gaps will not improve your pension. Some people can get credits instead. Speak to the Future Pension Centre before paying. Go to gov.uk. Check your state pension forecast. Check your national insurance record. Look for gaps. Then find out whether filling them actually increases your pension. Because this is the one people ignore for decades, then discover when it is too late. So which of these made you think, hold on, I might be leaving money on the table? Was it your tax code, pension relief, child benefit, national insurance record, or one of those quiet allowances nobody talks about? Tell me in the comments. And if you want the follow-up, I will do 10 HMRC refunds and reliefs people forget to claim before the tax year ends. None of this is magic. It is just the half of the tax system that only works if you already know it is there. Now you do.